Hello friends, welcome to Unit 15 of Financial Management. Unit 15 talks about dividend discussions. Here in dividend decisions, we will talk about or we will discuss about the decisions of taking a dividend. This module will help you in understanding a traditional approach in Indian economy for the dividend decisions. We will also understand dividend relevance model. We will understand stability of dividends. We will also understand the form of dividends and the stock split. Let's go further. What do you understand by the dividend? Who is entitled to receive dividend? All the stakeholders of the company, who are the shareholders of the company, are entitled to receive the dividend. If I talk about a broad terms, company whatever profit it makes is divided to the shareholders or the stakeholders of the company, and that is divided and given to the stakeholders in form of dividend, right? And that's a traditional approach. When I say traditional approach, it means that the approach where all the company when make a profit, it paid to all the liabilities, it expenses and other thing has been taken out, and after that what remains, the profit, is nothing called as the net profit. And this net profit is first paid to all the debentures holders, and then whatever balance remains with the company is given to the shareholders in form of dividend. So the calculation, if I talk about the calculation part, symbolically the traditional approach of dividend is expressed by way of P is equal to MD plus E, where P is the market price, M is the multiplier, D is the dividend per share, and E is the earning per share. We'll move further. We will go further and understand what are the different models of dividend. There are two models, relevance model of the dividend. The first is Walter model and second is Gordon model. Let me explain you. First, the Walter model. Walter model was formed by Professor James E. Walter, and he always considers the payouts are relevant and have to be bearing on the share prices of the firm. He stated that all investments made by the company cannot be separated from its dividend policy, and both are interlinked. That means they both are dependent on each other. However, the choice of the appropriate dividend policy affects the value of the firm. What Walter want to specify further, that Walter's model here clearly established that there is a relationship between the firm rate of return and its a cost of capital. When I say firm rate of return, it can be symbolically R, and the cost of capital symbolically K. So what Walter established a relationship between the firm rate, that is R, and the capital, that is K, to give the dividend policy that maximizes the shareholders' wealth. The firm would have to optimum dividend policy that will enhance the value of the firm, right? So company declaring the dividend to the stakeholders is considered that the company is making a good profit and it's a blue chip company, or the company is a good company where the people would like to invest. However, when Walter suggested the cost, that is a cost of capital and the rate of return, it based on certain assumption. First, it is financing. What it assumes, Walter assumes, is all financing is done through the retained earning. What is a retained earning? Retained earning is the earning which is remaining with the company and is the only source of finance available with the firm. Second thing, Walter's model assumes that it has a constant rate of return on the capital. The cost of capital will not give a constant rate of return, and the cost of capital may not remain the same. It can change from time to time. The third assumption of Walter model says it's 100% payout or retention. It says everything whatever company pays company makes a profit, 100% is paid to the shareholders in form of dividend. However, it is board's decision whether company want to declare 100% as a dividend or company want to restore something. And the next is constant EPS and DPS. When I say EPS and DPS, it is nothing but the company's constant earning per share, EPS, which is not the constant in industry. And the last assumption is life. The firm has its own perpetual life. Walter's formula to determine the market price, it says that P is equal to D upon KE. That is, P is the market price per share is equal to dividend per share upon the cost of capital. And it also says that growth rate of earning and earning per share, and that gives IRR, which is little complicated. It is actually not possible. So Walter model has 5 assumptions. First is financing, second is constant rate of return, the cost of capital, third is 100% payout retention, fourth is constant earning per share, right, and the life of the company. However, there are certain limitation, or we can say disadvantage. The first disadvantage of Walter model is investments are exclusively financed by retained earning. No external financing is used. However, the company can go to use for the external financing, which is disadvantageous. Is applicable. This limitation is Walter model is applicable only to all equity firms. Not necessarily that company sells only equity. Company might have debentures also. And finally, the last assumption or limitation is KE is also assumed to be constant, and that ignores the business of the risk. When I say KE is nothing but the cost of capital. It says cost of capital is assumed to be constant, which is not possible. Right? We'll go further. Jordan's dividend capitalization model. So Gordon's dividend capitalization model's assumption, the first assumption it takes is, before going to the assumption, you should understand what is Jordan's dividend capital model. So Gordon's dividend capital model, it was developed by Myron Gordon, also contends that dividends are relevant to the share prices of the firm. Gordon uses a dividend capitalization model to study the effect of the firm dividend policy on the stock price. And it is based on certain assumption. Gordon's dividend capitalization modules, the first assumption is the firm is in all equity firm with no debts. It is not possible the firm will not have any debt. Second is an external financing is used as absolutely nil. That means there is no external financing and only retained earning are used. And it says second is constant return. The return will not be constant every year. And the life of the firm is indefinite. And the second last assumption is the retention ratio, that is G is equal to BR, is constant forever. And the last assumption is cost of capital is greater than BR, then in the cost of capital is higher than BR. Before moving further, let's take an example of assumption in Jordan's dividend capitalization model. The first assumption, as we discussed, the firm in all equity firm with no debts. Second is no external financing is used and only retained earnings are used. Third, it assumes a constant rate of return and the life of the firm is indefinite. Fourth is retention of ratio, and the last one is the cost of capital is greater than the BR. We'll go further. Miller and Modigliani model. The Miller and the Modigliani model hypothesis seeks to explain that the firm's dividend policy is irrelevant and has no effect on the share prices of the firm. This module insists that the investment policy through which the firm can increase its shares value, and hence this could be given more importance. Right? And the assumptions are, first, existence of perfect capital market. When I say existence of perfect capital market, it means that all investors are rational and has no access to all information which are free of cost. There are no flotations or transaction cost. Securities are infinitely divisible and no single investor is large enough to influence the share value. Second assumption is no taxes. There are no taxes implying. And the third is constant investment policy. However, the investment policy of the company does not change, it assumes. The implication is that there is no change in the business risk proposition also. And the last assumption is certainly about the future investments. When I say certainty, dividends, profit of the firm had no risk. So these are the few assumptions in Miller and Modigliani model. We'll go further. We'll understand critical analysis of Modigliani hypothesis. And the critical analysis is, first one is flotation cost. What do you understand by the flotation cost? Here in the flotation cost, Miller and Modigliani has assumed the absence of flotation cost. And when I say flotation cost, it is nothing the cost involved in raising the capital from the market. If I have to recover the cost from the capital from the market, I will incur certain cost of ad, registration, expansion, all these are flotation cost. Second is transaction cost. This is another assumption which implies that there are no transaction costs. Like, what are the transactions we do in a company? Like brokerage involved in the capital market, which is a main criteria, and it assumes that there is a cost associated with the sales of securities by investors. Third one is underpricing of shares. What do you understand by underpricing? That means the shares are underpriced, devalued. For example, if the company has to raise funds from the market, it should sell the shares at the obviously lesser than the prevailing market price to attract the shareholders, otherwise shareholder will not attract. This follows at the lower price, the firm should sell more shares to replace the dividend amount. And the last one is market condition. When I say market condition, if the market condition are bad and the firm has some lucrative opportunities, it is not worth approaching new investors at the juncture, given the presence of flotation cost. We'll move further to understand the stability of the dividend. When I say stability of the dividend, that is, stability of dividend is consistently in the stream of dividend payment. That means that there is a stability of the dividend. Every time the company provides the same amount of dividend and the same percentage of dividend to its shareholders. Now, let's understand, keeping the stability of dividend is desirable. Why it is desirable? Because there are certain advantages. First is building confidence among the investors. Your investor have a high confidence in you. Second, investor desires for the current income. They always want to have some current income with them. And the third is information about firm's profitability. They will get the proper information about the firm, the profitability you are making. And the fourth one, institutional investors requirement. Their requirement is they want to have some good money with their company, and it raises additional finance also, and it creates your stability in the market. And that is why the stability of dividend is important. We will now discuss what are the different forms of dividends. The first is cash dividend. When I say cash dividend, most of the company pays dividend in cash. The investor also, especially the old and retired investor, depends on the form of payment for the want of current income. We have a scrip dividend. When I say scrip dividend, that is in the form of equity shareholders are issued transferable promissory note with the shorter maturity period, which may or may not have interest bearing. The next is bond dividend. When I say bond, the scrip and bond dividends are the same except that they differ in terms of maturity. Bond dividends carry longer maturity period and bear interest, whereas the scrip dividend carry shorter maturity period and may or may not have any interest on it, right? And the fourth one is stock dividend, that is bonus shares. Normally stock dividend is as known in USA or bonus share in India. In the distribution, the company gives additional shares to the shareholder as in form of bonus shares in India, and USA you call as stock dividend, right? With this, we will be going to the last part of today's module, that is stock split. When I say stock split, a stock split is the method to increase the number of outstanding shares by proportionately reducing the face value of the shares. Right? I would repeat once again if you want. Stock split is nothing but it's a method to increase the number of outstanding shares by proportionate reducing the face value of the share. A stock split affects only the par value and does not have any effect on the total outstanding amount of the share capital. And why do the company do the stock splitting? There are certain reasons, and the reason for the splitting of shares are, first, to make shares attractive. They want to make their shares attractive. The prime reason for effecting the stock split is to reduce the market price of the share to make it more attractive to the investor, so that the investor can invest more amount in the company. Second is indication to the higher future profit. That is, they want to indicate that in future we always make a higher profit. And the third is higher dividend to the shareholder. They want to declare higher dividend to the shareholders. Let's summarize today's earning. What are the different type of dividend we have heard? We discussed different type of dividend. These are cash dividend, scrip dividend, bond dividend and stock dividend. And what do you understand by the stock split and what are its advantages? Stock split is nothing but the method to increase the number of outstanding shares at the proportionate value by increasing the face value of the shares, right? And its advantages are, it makes shares more attractive, it's an indicator for a higher future profit, and increases the dividend to the shareholder. Any questions? Thank you, and have a great time and have a bright future and have a very good experience of finance. I'm sure the entire module of financial management has made you a perfect financial manager. All the best. Take care.